Hello and welcome once again to Policy Bazaar. I'm Arjun Bhagat. Now, every year we watch our finance minister read out the union budget on television. Many of us understand precious little. Our focus is usually on how cheap or expensive mobile phones, cigarettes, travel and hotel stays have become. Now, most of us have little or no understanding of taxes and tax liabilities. Tax planning is a crucial part of financial planning and if done efficiently can help you reduce your liability to the minimum. Now, to understand tax planning better and to understand how insurance can help us save taxes, we have Yashish Dhaya with us, co-founder and CEO of PolicyBazaar. Welcome to the show, Yashish. Now tell me, how much can an individual save on tax planning?
It would obviously depend on your tax bucket, how much your income is, and it'll also depend on, so the answer can be unlimited, but for most people, the answer would be about 41,715 rupees is the maximum you could save, assuming you were in the highest bracket of the tax slab.
So then how should one go about it, and at what age should an individual start making these investments to save that additional tax that he might or she might have to give?
So there isn't an age limit. So the moment you start working and you start having an income, you could start making these tax savings. So straight away from your first job. Obviously, it'll depend on your salary band because, yes, for example, in the first 2 lakhs of income, you don't have any taxes. So if you were earning less than 2 lakhs, there's no need for you to make these investments from a tax purpose. But there onwards, from 2 to 5 lakhs, you would have a 10%, and from 5 to 10 lakhs, 20%, and from 10 lakhs onwards, 30%. And if you're earning more than 10 lakhs, it certainly makes a lot of sense to make the investments which help you save on taxes because that money is just yours, and you wouldn't lose it.
So now we keep hearing about ATC, that you need to invest up to 1 lakh to save a certain amount of. I mean, just deconstruct that for us, and make our viewers understand what ATC is all about, and that 1 lakh that you can actually put in and save an additional amount.
Okay. So I will touch upon 2 concepts there. The first is what all comes under ATC, and the second is what are the different elements of those pieces and what all is exempt. So under ATC is a wide bucket. Comes life insurance, equity-linked saving schemes, the regular payment ones, PPF, national saving certificates, home loan principal amount returns. Even education loan returns, the principal amount returns. There are some forms of house pieces also which are allowed, but those are all and fixed deposits. If a fixed deposit more than 5 years, that also comes under the scheme. However, it is important to understand that, and you're allowed to save up to 1 lakh rupees under this. There are different categories in this. So there's ATCC C and there's ATCC-D, which all of these basically go towards pension plans. The ATCC-D is towards the national pension plan, or known as the NPF, which you're allowed to invest up to 1 lakhs or up to 10% of your salary, whichever is lower. You're allowed to invest that. And the ATCCC is for pure pension plans. Most of the pension plans offered by insurance companies, mostly LIC, etc. Now, the important thing to know is the exemptions are at 3 levels. And this is usually called EEE or EET or ETT. And I'll explain what that means. So the first, if you make an investment, you put your money in. On the money you've invested, you may get dividends or returns. And finally, you will take the money out. Now, for most of the investment types, as you put your money in, including fixed deposit, including NPF, including PPF, you will get the tax break. So if you invested 1 lakh rupees in the first year, you'll get the tax break. But when you take the money out, you will not get the tax break. And on dividends, you won't get the tax break. Insurance is the one category where the government has allowed EEE. So you won't pay taxes when you invest the money, you won't pay taxes when you get the returns or the money backs, and you won't pay taxes when you finally get the money at the end of the term. In pensions also, you will have taxes at the end. And this is the difference between pension and life insurance to some extent. And people usually get confused, what is a pension plan and what is a... In a pension, you will get taxed at the end. So your pension payouts are taxable. What you invest into the pension is tax-free. But when you get the payment back, that time it is taxable. So it is a form of EE.
And that's a point of confusion for a lot of people.
That is a point of confusion. A lot of people get confused that it should be the same, right? But if you invested in a ULIP plan, you will not pay taxes when you get the returns. Whereas if you invested in a pension plan, you will pay taxes when you get your annuity return. So annuity formats have got a tax element to them when you get that return, and that's an important element to keep in mind.
So now, can you elaborate a little bit more on investment avenues that individuals have, and also the lock-in periods?
So see, in terms of lock-in periods, most of these are for 5 years at least, because without 5 years you wouldn't get the tax break. The equity-linked schemes can be for as low as 3 years. The systematic equity-linked schemes where you pay monthly. But anyways, if you're investing in equities, you should not have a 3-year time frame because market variations can hurt you. So yes, typically 5 years is the time frame. In terms of the investment avenues, you've got insurance, you've got pensions, you've got PPF, you've got national savings certificates, you've got principal amounts to be paid back for home loans, which is not really investment, it's different. And you've got education loans that you may be paying back. So these are the different formats. The only thing to remember is, out of all of these, life insurance is the only one where you will not get taxed at investment, you will not get taxed on returns, and you will not get taxed when you get the final amount. Rest everything, you will not get taxed when you invest, but you will get taxed when you get the money back.
So let's discuss a little bit about
FDs, and fixed deposits.
Right. So now let's discuss a little bit about ATCCC, which is pension planning,
yes,
and ATD, which is of course health insurance.
Okay. So see, ATCCC essentially covers all the pension products provided by life insurance companies. There are a few of these. There are very few left because of recent regulations, etc., which are technically called pension, although you can structure a ULIP as a pension, and there are ways to do that. So you can essentially take a ULIP, keep it for 30 years or 20 years, and when you get the money back, put the entire amount of money in an annuity plan like a Jeevan Akshay or something, and you get an annuity plan. And essentially, so you can create a pension out of it. But they are not technically called pension plans. So what is technically called pension plans? There are very few left. I think there are 3 or 4 left in the entire market. And given that you will be taxed in the end, it's not such a great option. Now, coming to the health insurance part, which is ATD. So besides this 1 lakh rupees, you're allowed a further 15,000 rupees investment into health insurance annually for yourself if you are under 65. If you are above 65, you are allowed 20,000 rupees individually. Now the important part is, this 20,000 rupees may be either part or totally payable by your dependent children, not by children-in-law, and so you cannot pay for your parents-in-law, but you can pay for your parents. So if I have my parents, I can pay 20,000 up to 20,000 rupees for them.
So that's an additional benefit.
That's an additional benefit. So eventually, for an individual, that benefit can go up to 35,000. So if I have 2 parents, one of them can take a 20,000 plan for themselves, and I can take a 20,000 plan for the other parent, or whichever mix. I can do that. As many taxpayers as you have above 65, as many people as you have above 65, you can have 20,000 rupees per person. Of course, one taxpayer will only get the benefit once, but you can spread it out.
So Yashish, now can you elaborate a little bit on infrastructure bonds and what advantages they have?
Okay. So under ATC, you can have a maximum of 1 lakh rupee coverage, 1 lakh rupee tax break, which is all the different avenues we spoke about. There's only one exception, which is ATCCF, which is the infrastructure bonds. Under these bonds, you can invest a further 20,000 rupees over and above the 1 lakh. So your total investment under ATC, including ATCCF, can go up to 1,20,000 rupees. These infrastructure bonds typically give you returns of between 7.5% to 8.5%, which is pretty good. You have to have a lock-in period of the 5 years, and they will provide you that return. So that's infrastructure bonds.
All right, Yashish, you talked about ATC and some of the benefits that you get as a result of the home loan. Can you just elaborate on that a little bit?
So there are certain benefits that have been put out there for people who buy their own houses and take a loan out for that. You get 2 kinds of benefits. One is for paying back the principal amount, and one is for paying back the interest amount. For paying back the principal amount, you get a benefit up to 1 lakh rupees per year. So if you took a 15 lakh rupee loan and you want to repay it over the next 15 years at 1 lakh rupee principal every year, you would get that entire principal deducted from your tax, from your taxable income before you pay your taxes. The second part is the interest that you pay. Now again, if you had this 15 lakh rupee loan and you were, let's say, paying back interest of 2 lakh rupees a year in the first year, out of that 1.5 lakh rupees can be deducted from the taxes that you pay every year, so from your taxable income. So both of these put together give a homeowner who's taken the loan up to 2.5 lakh rupees of annual tax breaks, or effectively tax-free income, which, if you look at it overall, reduces your percentage paid back to the bank quite a bit, the effective percentage. So there's an advantage to having your own house. Now, one has to look at this with respect to HRA. If you own your own house and you are living in it, you cannot claim HRA for it. However, if you do not own a house in the same city and your house is in another city and you're living in another city, then you can claim HRA, and you can also claim the benefits of the loan principal repayment and interest repayment. So you can get both the benefits as long as the HRA is more than 10% of your income.
All right, now, we've talked about 80C, which is a little bit confusing. Then we've talked about 80D. And now what is Section 24?
So Section 24 is essentially for the interest component of your home loans. So whenever you're repaying a home loan, you've got the principal component and you've got the interest component. So you can get up to 1.5 lakh rupees as tax-free income, or a break in your taxable income, for the interest part of the home loan that you repay. So if you had a 20 lakh home loan and you were paying at, let's say, 10%, and you were paying 2 lakh rupees a year, out of that 1.5 lakh rupees would be tax deductible. And that's the advantage you get for paying back the home loan.
Right, now just suppose that I have an annual income of 10 lakh rupees annually. So what are the best insurance steps that I need to take?
Well, what you need to do is look at the comparison of where are the lowest costs in the various insurance options. If you decided to take a 1 lakh rupee insurance, just make sure you're taking the policy which has the lowest possible costs. Because you'll have to make two decisions. Are you going to invest along with markets, or are you going to invest in debt instruments? Once you've made that decision, you go ahead and take a ULIP, which is either a debt instrument or a market-linked instrument. Take it for a long term, take it for 10 years, 15 years. Invest 1 lakh rupees into it, and invest in the one that has the lowest cost. Do not worry about whose performance has been what, etc., because history does not repeat itself as far as investments are concerned. Tomorrow is a new day. So please just look at the cost side, and that should be a good investment for you.
Now, can you draw up for our viewers investment checklist? What do they need to keep in mind? How should they go about planning this? Because it is confusing, especially for someone who's getting into that tax planning, has got a new job. How does that person go about it?
See, my view is, basis the tax break that you require, you first invest in a life insurance instrument, which is that 1 lakh rupees that you get, because that will give you the exempt, the three exemptions. And keep that in mind, because when this 1 lakh comes back to you after 20 years, it will not come back as 1 lakh, it will probably come back as 3 lakhs or 4 lakhs. And at that time, you don't want to be ending up paying taxes on the extra income that you've made, which you would do.
So one really needs to look at it from a long-term perspective.
From a long-term perspective, I would say invest along with the markets. There was a very good saying somebody made to me yesterday, that you always, in the long term, you always lose out if you're invested in debt. You can never even retain your wealth or your well-being by invested in debt. You have to be invested in equities in the long run, and that's the only way you can keep up with inflation or beat inflation. So please invest in the equity side and stay invested for the long term. That is part one. Look at the infrastructure bonds. If you want that 7.5%, 8.5% return, invest the additional 20%. Look at your health insurance side. Go for a plan that has up to a 15,000 rupee cost, so that you get the tax break. See if you have older parents, older than 65. If they need a health plan, or if they are taking a health plan, make sure it comes onto your on your name. If they're not paying, if they're not taxpayers, that'll give you the tax break. Or if you're in the higher tax bracket, you should still take it in your name, because they would only get a 10% or a 20% break, whereas you may be getting a 30% break. So take these factors into account, and I think they should be good for you. There are other not so well-known pieces out there. So there is a benefit you get under something known as 80T or 80U, which is for disability. So if there's any disability,
so these are some of the lesser known sections.
Lesser known ones. So you get up to 75,000 rupees as a tax break. If somebody else in your family has a disability, you still get a 75,000 rupee tax break. you're allowed to invest up to 10% of your income under 80 GGC in charities and political institutions,
political parties.
From 2010, in a political party, you can invest any amount and get a tax break. So there's no limit on it at all. And that's why I initially said you could almost take your tax piece to zero if you invested all your income in a political party. So there are a lot of these coming up. Yeah.
Right, Yashish, now it's time for a short break, and after the break, Yashish will answer your queries. So do write to us at ask.policybazaar.com. On Facebook, you can write to us on /PolicyBazaar India, and Twitter users can write to us at PolicyBazaar_in. We'll be right back with your questions on Policy Bazaar. Keep watching.